right. Good morning, everybody. Happy Wednesday. Hope you guys are all doing well. We're going to get started here in just a minute. And I've got a focus here on the energy sector this morning and two signals that I think are not very well watched by a lot of people. So we'll go through those here in just a minute. Hopefully we'll be able to get started here in just another minute or so. All right. Yes, good morning, everybody. All right, let's get started. Let me give you another 30 seconds or so. I want to stay on time. Okay, very good. Let's get started. Good morning, everybody. Happy Wednesday. This is one of the best times of year, one of the most interesting times of the year for the market, but also sports. I don't know how many of you guys watch sports, but we've got obviously football, we've got baseball, basketball is going to start soon. Hockey is, I think, like 1 or 2 weeks away. Golf, of course, is out there. Tennis, I'm not quite sure. Anyways, if you like sports, this is a good time of year for U.S. sports, of course, in that case. Anyway, let's have a look. So first of all, this is a quick FYI. I mentioned this earlier this week. We do have a bunch of Fed speakers today. This is just as an FYI. Today is the 2nd of October, of course. So we've got 1, 2, 3, 4 of them. We had 3 yesterday, or actually Boston yesterday. Today we got 4 individual ones, so that's an uptick in flurry. And then tomorrow we get Kashkari. He tends to, stir people up a touch, willingly or not. I don't know. I'm just saying, like, he does tend to do that. So we'll see. But that's what's going on. Just as an FYI, it doesn't really, change things that much. But just so you know, that's what's going on. Now, two things that I would be surprised if most people are watching this morning. And then we'll look at the energy market. I think there's opportunity there. So what are those two things? First of all, bond market volatility. So the bond market volatility, and this is treasury market volatility, can be measured using something called the MOVE index. And so if I bring up the MOVE index here, I'm going to bring up just the chart because that's what we're looking at here. It's this purple line. And you can see that the MOVE index had a pretty sharp move over the past couple of days. Does that mean the world's about to fall apart? No, but it's interesting to note that bond market volatility is up this much. What does it mean? We'll see, right? It's typically, maybe a sign to just be a bit careful in the bond market. So if I was long a lot of bonds like TLT, I would just at least be on alert. I do want to bring to your attention, and we mentioned this to Inner Circle members yesterday in the members session, that if you look at yields, and we'll look at short-term yields here for a minute, the bond market in terms of yields is actually a little bit higher now than when the Fed cut those 50 basis points on the 18th of September. So yields are actually up. It's like less dovish. All right, so if we were to see a big jump in yields, the stock market probably isn't going to like that too much. So that's just as an FYI. I realize most people don't care about the bond market. I'll tell you, it's probably one of the most important things you need to learn how to read. But that's something I'm watching. So this bond market volatility, again, the MOVE index is up quite notably. And the third point here, and here I would be surprised if literally anyone here is watching this. And that's credit default swaps of the United States, 5-year CDS. I don't want to get wonky. I don't want to sound important. The point is I'm trying to show you stuff here that I'm not quite sure, or this is not going to be on CNBC this morning, right? And if it is, it'd be very surprising. So credit default swap measures the default risk of a company, or in this case, a country. Is the US going to default? Probably not, right? That's not the point, but the credit default risk has gone up. And the reason why I mentioned that this is interesting is because it's lining up with that spike in bond yields. What does that mean? Well, again, I don't really know exactly where this is leading to, but I can tell you that if this were to be at all, in sync with each other, and it probably is to some extent, it wouldn't be completely out of the ordinary to expect that maybe we get a jobs report this Friday that's quite strong, in which case the Fed probably can't drop rates too much, in which case the equity market may have a hiccup. That's just one thing that comes to mind. We could see a totally different way of it playing out, but this is definitely something that I'm watching very closely. So again, credit default swaps of the United States are up. Bond move index is up. That's bond treasury volatility. I understand most people don't care. I will tell you ultimately this will be the only thing that matters at some point. So hopefully this is giving you a little bit of perspective of some things that are being watched on the hedge fund side, on the institutional side, and so on and so forth. So those are two things that I would encourage everyone to be aware of. Hence, I want to spend a couple of minutes on this. The third thing, and this is now more on the stock side, so those people that just fell asleep before you can wake back up again, because now we're going to talk about stocks again. And that's basically the energy sector. Now, we have been making a big deal about the energy sector. It's one of my core long-term asset allocations I really want to focus around. This is the XLE, the energy sector ETF. And, one of the things that I know that we are going to have is we're going to have more demand for energy going forward. We're going to have more demand for energy. And if you don't care about energy on its own, and you think about where does that demand come from? Well, yes, we could see a spike in oil, which was happened yesterday, which is why stocks like ExxonMobil were up. That's certainly a possibility. That's more short term though. But what about structural demand for energy? Well, the global middle class is still rising. People coming out of poverty more and more. Countries like, India, huge continent, actually coming more and more people out of poverty at an increasing rate. All that increases demand for energy. What about closer to, hey, Serge, I want to buy NVIDIA and don't tell me anything other than NVIDIA and maybe Bitcoin. What about AI? Okay, for those people who just care about the headline, AI needs energy, right? Now, it might need more natural gas than anything. That's kind of what the baseline is right now, but that's going to be bullish energy. So the energy sector, broadly speaking, could benefit from that. What about the build out of this whole clean energy movement, right? Well, that is likely going to happen, that build out, and it requires traditional energy drilling to make that happen, right? So there's a lot of tailwinds here for energy, including that being inflationary, right? So for some of you guys who were in our Inner Circle member session webinar yesterday, or on our ETF Silo Pro member session yesterday, we talked a lot about this, higher inflation for longer, and all the, or at least some of the key reasons why that's going to happen. So to me, I want to be long ExxonMobil. I want to be long XLE. These are more than just trades. These are asset allocations, but I think ExxonMobil here is even a potential trade. In fact, we added ExxonMobil this morning to Inner Circle as a trade. If you're an Inner Circle member, you should be receiving that trade alert here momentarily over the next, I would suspect, a few minutes or so in your email. It's already written up inside the Market Rover. So those are three things that I'm watching here this morning. If you guys have any questions on this, please let me know now. Again, tailwinds in energy. There's the short-term tailwind, and then there's a structural tailwind. So maybe somewhat higher oil prices are going to be bullish for ExxonMobil and the energy complex, but the structural tailwinds of energy are way more important. Also, and I should have mentioned this before, the energy sector is currently about 3.5% of the S&P. Traditionally, it's closer to 8 to 10% of the S&P. So, there's a huge misallocation of capital, and I promised people, our clients, that I'll start talking a lot more about that going forward, and so more or less now is the point to start talking about that. So there's a tremendous misallocation of capital in most people's portfolios. It's not even funny. It's like trillions of dollars, and actually it's not funny. It's because it's going to hurt a lot that people are misallocated. So energy, huge tailwind, dramatically underinvestment. A little bit, you can look at it a little bit like China. Like global portfolios, I mentioned this last week. Global portfolios are dramatically underweight China. They still are. But now we had a game changer moment last week, so people have to catch up and change their portfolio. The individual investor U.S. investor isn't invested much in China, so there's not much of a change to be needed because they typically don't invest in China. But they do invest in the S&P 500, which means tech stocks and to a little degree right now energy. So if that rotation flips from tech stocks no longer being 40% of the S&P, if you truly calculated, going down to 20-25% of the S&P, which is highly likely, and the energy sector becomes from 3% or 3.5% goes to 8 or 10% of the S&P, that is going to destroy a lot of people's portfolios if they don't make that change. So that's just a little bit. We got a short-term question. All right, Mike's asking, is the China pop likely to be short-term? No, I think this movement in China is a game changer, but I wouldn't chase it here. So like mainland China markets are closed, and I mentioned this yesterday, for another week or so. Hong Kong opened again today for trading, but no, I don't think this is short term. I do think we can retrace. Can the FXI ETF, go back into the high 20s? Of course it can. I mean, that's this has been a crazy move. But I personally want to respect this, and I want to increase my exposure in energy. John's asking about gold and silver. Unchanged. I have no difference in view in gold and silver. I remain long. Again, this is the question: is are you talking about a trade or are you talking about an investment? So I am very bullish, both gold and silver. This goes into the long-term inflation story. I really, really, really want to be long that stuff. I am long that stuff. And, is gold running a long way? Yes. Can it pull back? Of course it can. So am I going to buy more gold here personally? No. We've been long gold now for 13 months at max exposure. I'm going to take some off probably here at some point, but I'm as bullish as I still can be from an allocation perspective, right? I find trading gold is very difficult. I want to just be allocated to it. So that's kind of that. It's an asset allocation question, right? We live in a trading bubble, meaning most people have stopped thinking about how to be an investor, and they're just constantly trading all the time. And listen, I trade too. Obviously, you guys all know that. I trade quite a bit. But most people we talk to that are self-directed have stopped thinking about investing, and they're just trading. And that we know that empirically leads to a huge underperformance in returns. What we advocate is be allocated, have a portfolio, be allocated to the proper things, be diversified, and then trade around the edges. Most people right now are doing the opposite, and that is going to cause a lot of problems down the road. But anyway, quick recap here, and then we're going to wrap it up here. Again, long energy is something that we really like here. Then also, I want to make people aware of the MOVE index. The bond market volatility has gone up a lot over the past couple of days. Mentioned that here before. So that's, and then we couple that with basically the credit default swaps. This is the default risk of a company, or in this case, again, it's a country here in the United States, has gone up. Is the United States going to default? Probably not, right? But it's just the risk has gone up along with volatility. So I would expect the bond market to see more volatility here going forward, particularly in the long end. On the short end, I'm not quite sure if much is going to change. So anyway, here we are, 15 minutes, we're about 15 minutes now. We will be back here. Today's Wednesday. We'll be back here tomorrow, Thursday, to look at another day, another morning, more opportunities. Again, it would really help us if you guys subscribe to the channel and if you give us a thumbs up, because the algos pick it up and then we get more people exposure. Also, if you're not a YouTube expert, I would encourage you to create a YouTube account. It's free because that way you're going to be alerted when we do these morning sessions. That way you don't have to wait for an email in your inbox or some other way of getting a link. That way you're alerted every morning with a little pop-up on your screen. There's a lot of reasons why creating a YouTube account makes sense. I'm not advocating it. We have no financial benefit from YouTube. I'm just saying, like, it makes it easy for you to be able to access these morning shows. So please, I would encourage you to do that, and then you get alerted of the morning show here every morning, including any of our new videos. I'm recording 3 awesome podcasts, including the K-Web, the manager of the K-Web ETF. I'm once again interviewing him today. That interview should be out in a couple days, and then I'm working on 2 more awesome podcasts. All that stuff is going to be updated here, and you'll be alerted in real time if you have a YouTube account, it just pops up, right? So just trying to make your life easier, because we realize a lot of people watch YouTube. Everyone watches YouTube, but certain generations don't create YouTube accounts because they just don't know what the benefit is. But that is a great benefit. So anyway, hope it was helpful. Again, thumbs up, and if you guys could subscribe to the channel, that would help. You need to create a YouTube account if you want to subscribe to this channel, or even I think for even for a like. Because if you don't have a YouTube account, again, it's free, you're not going to be alerted when we do these live shows or when there's new videos. We create a lot of content every week, right? You need to have an account, an actual YouTube account. You can just go up, it's up wherever in the upper right-hand corner or something, where you can just create a YouTube account. That way you're alerted to when there's new videos, like when this show is, and all our podcasts and latest analysis and stuff like that. So there's a lot of reason for creating a YouTube account. Anyway, thanks so much, folks. I'll see you guys. If you're an Inner Circle member, I will see you in the chat room or Gap chat room, depending on where you're a member of. And we'll see you again tomorrow. Thanks for being here.